Recording. All right. Hey, Shane, how's it going?
Hey man, it's going well. All things considered, going better for me than it is for the stock market these days.
Yeah, it's sold off quite a bit. The last time we spoke, and just for everyone watching, this is recorded on April 28th. The last time we talked, Powell was going to be speaking at the IMF right after our meeting, and we talked about the significance of running up here right into the 200-day moving average, and it was failing at that moment. I think we were halfway through this bar, but we've seen the sell-off come through here, and what I'm watching, it's always back to not predicting markets, but this 416 level on SPY, so I drew the line down here, close below that certainly means, I think more downside. If you wanted to place a trade long, it's a bit of a gamble on this one, but you could set a stop below that line. Maybe it goes higher, but it's just kind of churning in this kind of range right now. What are you seeing?
Yeah, if you're into picking bottoms, you could buy it here, 422, set a stop at 415. You'd be risking $7. And you'd have to, I think, anticipate a run back up to the 200-day moving average at 448, maybe up to 437. But I mean, 437 minus 422, what is that? So $15 of upside, maybe $4 or $5 of downside on that trade. So it's not a terrible risk reward, but we were both pretty bearish last time we talked. Nothing has changed my mind about being bearish. There's really nothing in the bullish camp right now, nothing to get excited about in my opinion. So I would not take that trade personally. It's, as they say in this business, picking bottoms, the only thing you can be sure of is that they lead to stinky fingers. So I don't pick bottoms. It's a dirty job and I don't do it. So not picking the bottom here. I think we could go materially lower with the Fed getting ready to tighten into a slowing economy. We'll get to GDP, I think, probably before this call is over, but the economy is certainly slowing and the Fed is threatening to tighten aggressively next week at their meeting, the 3rd and 4th. So we'll find out on Wednesday of next week, just before we do our next call, what they decided to do. So I think there's a lot of reasons to be very, very cautious, if not afraid. And I'd rather hold US dollars than SPYs.
Yep. And I agree. If you're investing right here, I mean, you could take a stab at it with a little bit of your portfolio, but I just think that overall we're at the spot where we're under the 200-day. There's a major level of resistance up here at 457 on SPY. It's not the most bullish setup. So
I mean, that's a 7% drop from the 200-day moving average to that green line you got on there. That's about 7% is what the market dropped since the last time you and I spoke.
Yeah.
So, that said, we'll probably get a bounce, we'll probably get a little bounce, maybe a bounce up into the declining 50-day moving average and then, and then back down again, because there's no good reason to be long this market. That said, there was no good reason to be long the market last year either. It was just kind of like a hopes and dreams thing. But the difference is that last year you had the Fed, that you had the Fed buying bonds and keeping rates artificially low and effectively easing monetary policy last year. This year, you're going to have the opposite of that starting like next week. Well, I guess starting already. They already raised by 25 basis points. So it's already underway. I don't know. It's a very different situation this year than it was last year. So can the market rally on nonsense? Absolutely. It could do it for a long time, but it can also go down a lot further than people expect too. And I don't think there's enough people out there who are like afraid yet. There's lots of dip buyers out there still. So those people can still get wiped out on this drawdown.
Absolutely. And I could see something like, I'll draw it, but we could rally back up here about where the 50 would end up and then roll back over. And, it's always important is that the market doesn't just move in a straight line. So it's likely to churn here and then kind of make that move. But right now, just nothing's really that clear. So it's not a great place to be picking a big trade here, but I think it certainly looks bearish.
Pretty standard bear market behavior for that to happen right there.
Absolutely. So, well, let's turn to, so gold, we always talk about that one. So I'll pull that up.
Hey, you know what? Just real quickly before we jump into gold, can I share my screen real fast?
Yeah, I'll turn it over to you now. Go ahead.
One thing here. Just give me 1 second. I gotta get the right chart up. I thought I had it ready, but I guess not. Um, here we go. QQQ is what I'm gonna pull up. All right, so share my screen. Here we go. So this is the QQQ chart of the NASDAQ 100 basically. And I just wanted to show that, you know, for the 1 year between, it was April 26th of last year to April 26th of this year. I don't know if you guys can see those, so I'm gonna make them a little bit more bold. The market was down 7.04% if you're looking at the QQQ. So the tech stocks were down for the 1 year. And a lot of people just don't realize that. They think, oh, last year was a good year. If you look at it on average, probably up. Well, if you had put your money into the market on April 26th of last year to April 26th of this year, you would be down in the QQQ. And that is not something that happens very frequently. And if you look at even from like today, so if I move to the 28th to the 28th, you're still down 4.86% over that 1 year period. So that is despite, you know, the index rallying. It was up 29% at one point from the lows in March to the highs in November of last year. It was up 29% and you'd still be down over that 1 year period. As of right now, you know, from that high to where we are today, the QQQ is down just about 20%. At the lows the other day, it was down 21.5%. So not a very healthy uptrend. Not an uptrend at all. I mean, this is flat to down, and I still don't see any reason to get bullish. You know, you could go out and try and buy this dip, but you could have tried to buy, you know, you could have tried to buy this dip, and you could have tried to buy, you know, this dip. Oh, I can't draw. Anyway, there's a lot of dips to buy, and every one of them got met with, you know, lower lows. So I think we're in a downtrend, and I don't think that's likely to stop anytime soon.
Mm-hmm. Absolutely. And, you know, on that, I'll just touch on it really quick, but, you know, let's look at the Qs and some of those. NVIDIA, we've talked about that in our last kind of meeting here, but look at this one. I mean, if you want to look at what's leading this lower, NVIDIA, that was a real bull there. So here we had a high that we had set, and that level is really holding. So here it's been tested multiple times, and now it's broken through. Earnings are, it looks like on May 27th or May 26th.
Click that and it'll tell you. Click that little E.
Yep. Yeah, so May 25th is the next earnings report, and we're back under a pretty major level of support, and NVIDIA has really been the leader in this. So with that breaking and the Q's already in a downtrend, I think there's more room to go down. And, you know, next level of support, I suppose I'd be looking for in that one, maybe down here at the top end of this range. So down here at the kind of 153, I'd love to pick it up there. I think that's pretty solid level of support.
You got the old death cross showing there too recently. So 50-day dropping below the 200-day from above. So that's just all lots of bearish stuff going on.
Yeah. And I think with a catalyst with earnings here and it already trending down, I wouldn't be surprised to see a gap lower on earnings, and, you know, maybe it finds a base around there.
I wouldn't even be surprised to see it pop on earnings, but that doesn't mean you ought to buy it there either. I mean, just like Facebook this morning, you know, one good earnings report isn't enough to get somebody out of the woods. When these things go back to bullish trend, you'll have plenty of time to buy dips. You have the rest of your life to buy dips. You don't need to pick the bottom.
Mm-hmm. And here's one too, you know, so Netflix, just another kind of tech darling that has just fallen. Here you broke a major level of support. Then the next earnings broke another level of support. And I don't know where the bottom is on this one, but just another, you know, name that's in there that has just gotten taken to the cleaners, for lack of a better term. And, you know, I think that's common across that industry. You know, Google too. I'll pull that one up. We just talked about that one recently, but it's kind of that same thing we're looking at there. So there was your major support.
Why do you start your lines in no man's land? I'm curious. Like, where you just like put them wherever? Or is there a reason you do that?
So I actually, since I have the crosshairs on here, I just tend to line up that crosshair and hit it. But I think for everyone's understanding, why there is it was this earnings high, put in that higher node. And then down here, we came back for a back test, and that also lines up about where all those bottoms are. So that's kind of a major level of support that I've been keeping an eye on.
All right. Yeah, I just didn't know why you tend to draw your lines like they start like at just very random places. So anyway, no worries. Just wondering. Yeah, Google is one that actually on a fundamental basis is quite cheap. Even though it's trending lower, again, showing the death cross with the 50-day underneath the 200, breaking the support that you're talking about. So, it could get even cheaper, no doubt about it. I mean, the interesting thing, Netflix is still actually pretty expensive. I mean, not relative to history, but relative to like what I usually look at as a good value. Google, on the other hand, as a function of, its operating income and a lot of other metrics that I look at on the fundamental side. I was just doing the analysis this morning. It's 21 is the PE on Google. Price to sales is 5.9 times. Enterprise value to EBITDA is 14.7, so not bad for a company that's growing revenue at 23.4% compounded over the past 3 years. And based on its operating income, I think it could easily be worth 1.6 trillion dollars, and it's currently only worth 1.5 trillion dollars. So that implies 17% upside based on just its operating income. And that's not a very common way to value stocks, but on the fundamental side, I mean, if you just looked at operating income as the money available to pay back a loan to take yourself private, Google could afford, based on its current operating income and an interest rate of 5%, it could afford to pay $1.642 trillion to take itself private. And just out of its own operating income, it could afford to pay the interest back on that loan. So if you ever find companies like that could afford to take themselves private, right? There's effectively no material risk in buying their stock versus buying their bonds. And obviously, well, maybe not obviously, but there's a lot more upside associated with owning the stock than there is the bond, especially in today's world. So Google's pretty cheap compared to most other companies that are A, that big, and B, growing that fast.
Absolutely. So we'll see if that can base a little bit and find a new layer or level to risk off of for a new long. I agree. I think that valuation certainly justifies, picking that one up possibly.
Yeah, after it splits, I'd be selling put options. It's kind of hard to trade options on a stock that's that expensive because 100 shares at $2,000 is quite a bit of dough. Not everybody's got that lying around. So after it splits, which I think is coming up soon, that's a great trade for that thing, is to go sell some put options way down below where it is now, where you'd like to buy it.
So, and then, the next one here, kind of back to the macro conversation, but here's gold, and you can see all our triangles that we've been drawing over our podcast or our conversations here. And here we are again. So
just breaking hearts.
It's just, if it didn't frustrate people before, it sure is now. I mean, there it retested a low, and now we broke back below the 50. And remove this drawing. We had that on there last time, but broke the 50 there, came back down, retesting this prior low. I don't know about you, but for me, it's just, I understand the inflation narrative and gold's going to be the best inflation hedge and everything, but this chart's just, it's not going anywhere too fast. I personally just, I have a position, but I wouldn't be overweighting it, thinking that with everything going on, geopolitics and inflation, this just, I mean, isn't this the prime time for gold to just go to the moon? You've got a potential war, you've got inflation, and it's hardly done anything.
Yep. I do not have any positions in gold right now. It does not show Doesn't show any trend, anything that would get me excited about it. So I've tried to buy the breakout a couple of times here, made a little bit of money, lost a little bit of money. But for now, I'm out.
Yeah. And it's one of those things where, yeah, you could buy it here and it takes off and you're right. But the risk reward and the probability, I mean, especially the probability on a chart like this, you can prove that you're really smart and try to get in and have the right entry, but there's just better looking charts out there.
Yeah, no, this is dead money. I don't. And again, that's in my personal trading account, and in a long-term investment account, I think owning some gold and holding it for the long term is just a hedge against chaos, right? It's the chaos hedge. So that's something I would keep and hold on to for the long run. You know, for maybe 5% of your overall portfolio, sitting in gold is a nice insurance policy, because if that gold doubles, it's because everything else in the portfolio probably went down by a lot. So
Right.
so holding gold as a chaos hedge is a good idea for a long-term diversified portfolio, but I don't think it's a good trade right now.
Yeah. And then, the next one is oil, and oil, it's holding this 96 level right now really well. So that's certainly one where if it breaks below that, I'd want to be getting out right below that. But it's holding that, it's consolidating, which makes sense. I mean, it had a huge move all the way from, $60 all the way up to 130. So not surprised it's kind of taking its time. It still looks constructive to me. It's not following my line I drew
Nope,
last time
not
perfectly,
following
but
anymore. Nope, it was for a minute, but gave up.
so we'll remove that. And it's a good reminder that, it doesn't just take off. Moves like this take time. So this could tighten up a little more here and then, start working its way higher. But as long as it holds 96 down here, I'm constructive on oil. And fundamentally, I mean, everything lines up to support that too.
Yeah, I mean, it's trying to break out from the newest, if you drew another line connecting the recent highs, if you'd see that today, it's breaking above that, breaking above the 50. So I think that's yeah, I wouldn't even start it where you did. I would just start it at that recent high, but it doesn't matter.
But
Doesn't
yeah,
matter.
so
You draw your lines different than me. You see that $96 one is way out there in no man's land.
we'll move it over. There we go. But yeah, it still looks good. So it's kind of one of those, if you're trading it long, you want to be exiting at 96 and then, whatever upside you're kind of looking at on that. But I think the risk reward on that one still looks good. And just that's a nice trend. So we looked at gold and we said that's a broken trend. This is a better looking trend. So it goes up, it consolidates for a while, works its way higher.
Yeah, if I had to pick one, I'd rather be long crude oil than gold right now,
Mhm.
just based on that chart. Oh, that's funny.
So then let's talk here, yields. So just looking at the 10-year, man, talk about a nice trend. I mean, here's the 10-year. It just keeps going higher. I don't know what else to say there.
Yeah, I breaks the 3% bound and look out. I think that is not good overall for the economy. It's probably good for people who want to earn some interest. Loaning the government money for 10 years, you can get 3%. That'll take some heat off of the stock market immediately, because there are plenty of people out there whose world works just fine with a return of 3%.
Hmm.
And I mean, if you want to, we call the 10-year bond return-free risk around our office, not risk-free return, because loaning money to a bankrupt government that's willing to print itself into submission is, probably not that good of a long-term idea. But I mean, this is the highest rates have been for a pretty long time. So it will attract some capital that was otherwise in stock market, and it'll probably take capital from things like utility stocks and other bond proxies, other income type, dividend investments that have already gone up quite a bit. People might want to take their profits off the table and shift some of that over to a 10-year treasury bond paying 3%. So I think that's probably another thing in the bearish category for the overall market. The higher rates go, the lower the PE ratios should go on the S&P 500 to represent fair value.
Absolutely. And you've got it. I mean, it's just consolidating right here. Looks like today moving higher. There's I don't see anything stopping this in the short term here. I mean, it's still just a constructive trend, keeps going higher. And as ever, we all know, is the 30-year mortgage and kind of mortgages in general are usually benchmarked off the 10 years. So tack on the extra yield for the added risk of lending to a consumer. And that's where we're at, is probably looking at some higher mortgage rates.
Cool.
So, and then, I'll pull up one last thing, but just when we're talking about the overall kind of market and where we stand. So here's the VIX.
Go VIX, go.
And you can see we're just in the top part of this range. It's been just kind of a big consolidation here, maybe going higher. And volatility doesn't trend like everything else because volatility is mean reverting by nature. But
Do you look at the futures contract on VIX? Is that what you really look at? Is that standard for you?
yeah, so that's what I look at as the VIX
Oh.
here, just futures.
Yeah, I look at the index. I don't ever really look at the futures. I watch the futures, I guess, a little bit in the overnight markets, but in my experience, I just look at the index itself. But
Okay.
it doesn't matter. I don't think it's that much different. I just I find that interesting.
But we're still up here. So if you're somebody and you're investing for the long term and you want to pick a really good position to start putting money to work, you don't really do that in a VIX environment like this. You want a low VIX environment. You want a nice, quiet, upward trending market, not one that's chopping around and doesn't really want to give you a solid direction. So you can put a little bit to work, but when you get the VIX up here, it's just why try it? It's too volatile and that'll wreck the emotions. Better to wait for a little lower VIX reading and then start kind of putting some money to work there.
Yeah, see, you know what? I'm just looking. Those values are quite different than the actual index. Like if you put a compare on there, like hit the plus. No, don't change it. Just hit the plus right next to that ticker symbol. Just type in VIX.
Is that this one?
Not futures. You're always good on the futures. I don't know why you do that. Yeah, I don't think it was that one either. That's the CFD. You don't want that. You want the other one, the actual index.
Is that which one is
CBOE volatility index.
that one?
Yeah. See how much different it is?
Little different. Looks like maybe just a touch higher.
I mean, it's
for
the
today, but-
correlation is one, but it's like the valuations are different. Yeah, I mean, they're very different. The spikes, and on the actual VIX, the high of the year was January 24th, but on the futures contract, it was showing in March. Like they're just differences.
Yeah.
Yeah, I don't know. I don't really pay attention to the futures contract. Not on that one.
All right. Well, I think the other one, we want to talk about is just the GDP report. So we had that recently.
Yeah, it came out this morning. I missed it. It was like 8:30 this morning. The first estimate of GDP for the first quarter of 2022 came out. And it's not only is GDP decelerating, but it was negative. So GDP contracted for the quarter based on their first estimate. So they'll probably revise that in some way. But we'll see what happens after they revise it. I think they revised it like 3 times as more data comes in. You want me to share my screen? I've got a.
Yeah, if you've got it pulled up,
Yeah.
I'll let you pull up the historical.
Well, I mean, you can chart it in TradingView too, but I just go straight to the source. So the BEA, what is that? The Bureau of Economic something? I don't remember what the heck the BEA actually is. It won't tell me either. But yeah, you can see right here that it is below the line. So GDP decreased at an annual rate of 1.4% in the first quarter of 2022. And I think that inflation is also slowing down at this point. So we have both slowing inflation, so rate of change down, and slowing GDP, rate of change down. That's what we call the quad 4 environment, thanks to our friends over at Hedgeye. And that is not the type of market to be aggressively long stocks. In fact, if you go and look at a back test of performance, what you will find is that the best performing asset classes include US dollars. And so we are actively holding more US dollars than we typically do in our strategies at Elevate. In fact, earlier this week, we decided to raise even more cash. We've been carrying 20, 22, 25% cash pretty much all year. And we are going to chart a course for closer to 50% cash for at least the short term here. I think the Fed is very likely to be aggressively raising rates when they come out on Wednesday of next week. They might even announce that they're going to reduce the balance sheet in some material way. And so I just don't see a lot of reason to be optimistic or bullish or taking unnecessary risks, especially with other people's money. When I buy things in my personal account, I usually have a tight stop loss, and the account's not that big that I can't get in and out very, very quickly. When we're talking about trading our clients' money, it's a little bit more diligent than that. It takes a little bit longer to get in and out of markets, and we don't want to be we're not short-term traders in our long-term investment accounts. So we try not to conflate those two things because you'll end up doing both poorly. So when it comes to our long-term investing strategy, we're pretty cautious. We're going to hold on to some of our best names, at least in some amount, but we're looking to cut our stock exposure across the board. And I think that it's possible when the Fed meets in June. I don't know the exact date of their June meeting, but if the market falls by enough and inflation falls by enough between now and their June meeting, I think the Fed probably will pause on hiking rates and getting more aggressive on inflation. But if the market doesn't drop, if it stays relatively high, doesn't drop too much further than where it is right now, and inflation doesn't kind of go away completely, I think that'll give them permission to get even more aggressive, which would be even more reason not to be long the stock market. So, every tightening cycle doesn't lead to a recession or a down market. In fact, the market most often goes up when the Fed is tightening its interest rate policy and monetary policy. But this time they're also talking about the balance sheet, and we also know that the economy is slowing based on this GDP print. So the Fed doesn't normally tighten into a slowing economy, and they certainly don't normally reduce the size of their balance sheet. In fact, it's only ever happened one other time in history where the Fed has reduced the size of its balance sheet. That was in 2018. And that was the last calendar year that the stock market was down for a full year. So I think there's a lot of reasons to be bearish. And the only real reason to be bullish is that the stock market can climb that wall of worry, as they say. Google wall of worry if you don't know what I mean about that. But in my opinion, there's just a lot more reasons to be cautious than there are to be aggressive. And this latest GDP print is fully what I expected it to look like, maybe even a little bit worse than what I expected it to look like. So we are in quad 4. This is where cheap stocks get even cheaper and expensive stocks get absolutely demolished. For example, we'll just maybe wrap it up with one thing.
Shane, just real quick, just for everybody. So June 14th and 15th is the Fed meeting, and it'll be a live press conference that's on the 15th. So
yeah, so here's one of those expensive stocks that's just going to get demolished. This is Teladoc. They were in the right business when COVID hit, right? They do healthcare through the phone or through Zoom or whatever you want to call it, and might not look like much, but this right here, this most recent move is minus 46%. This thing dropped from 50 to 30 bucks today. That's today. That's what happened today, right? If I switch to candles, you could see the big, massive gap there. And so this stock has dropped, let's see, yeah, from the highs, November of last year through yesterday, it was already down 80%. And then today it dropped another 46%, call it. So what does that mean overall, right? That means that the stock is down 90%. That's why I make the joke all the time. What do you call a stock that's down 90%? Do you know the answer, Kyle?
I don't.
It's a stock that went down 80% first and then dropped by half again. That's a stock down 90%. And here's the funniest part. Maybe not funny for some people, but funny to me. Kathy Wood and her super popular ARK Innovation ETF fund, right, which is also down 69% from its highs, right, after being, the most popular stock in the market all year last year. It was up 375%.
For ETF, right? And for
Oh yeah,
viewers, those
yeah.
are
Sorry,
going to be some of the tech leaders that she's picked out as
not
the
tech
next,
leaders, tech
or
dogs, just nonsense stocks is what she buys. Yeah, see, back here we were in quad two, where GDP and inflation were both going up. Even the banks go up in quad two. Anybody in the world can be a stock picker in 2021. And basically since the bottom of COVID, anybody could have been a stock picker, because no matter what you picked, whether it was GameStop or AMC or ARK Innovation or Teladoc, Zoom, Zillow, I mean, the Roblox, dude, I could go on and on and on. Stocks that were up hundreds of percent from the COVID bottom till November of last year that are all down more than 50, 60%. Netflix even. Facebook is down 50% this year, even though it's up today on earnings that weren't as awful as they probably could have been. But the point is, like you got to get away from this stuff. Teladoc is the number 3 holding in the ARK Innovation ETF. That's why it's down another 5%, or was down another 5% at the lows today. So I mean, it was even worse. It was down over 70% at one point today. So I just think it's amazing that people will, continue to buy this fund, continue to give a company like this their money, while the people who run the fund are not paying attention to what's going on in the market. They have no macro framework at all. They're just picking stocks and hoping that, eventually the market will turn around and recover. But the market can go down a lot further than anyone thinks. And just because this fund is down 70% does not mean that it can't go down another 50% from here, right? Just like we looked at Teladoc heading into earnings last night, the stock was already down 82%, and then it dropped by another 46%. So the stock market can stay irrational a lot longer than most people can stay solvent, and that's why we have stop losses. That's why we follow a diligent management process both at Elevate and in our personal trading accounts. It's because you can't get wiped out. You can't get wiped out and then live to fight another day. So we follow our stops, and ultimately, when these things finally start trending higher, and maybe they will, maybe Teladoc won't even go bankrupt. Maybe someday it'll break through this trend line. If that were actually a trend line, it's not. But if it were, maybe someday when it breaks through this trend line and starts reporting better numbers, and starts trending higher, putting in higher lows, you'll have the rest of your life to buy this thing on dips. There is no reason to try and catch this falling knife or pick the bottom or anything like that. There's just no need. You'll have the rest of your life to buy this stock if it ever starts going back, above the trend line. So there's just no reason to be picking bottoms. It's not something that we do.
Yeah,
and won't start.
The big thing too, it's just like anything else. Had you owned that, had you had a risk management plan in place, a predefined exit, is, hey, this might be the biggest company in the world 10 years from now, but why would you want to give back that much of your capital so that you could spend who knows how many years now you'll have to sit here and wait and let it churn or keeps going lower? Who knows?
I mean, a stock, most people don't know this either. And it's not because people are dumb. It's just people don't think in terms of arithmetic or mathematics. But look, a stock that's down 80% needs to go up 400% just to get back to even. So you're now asking a stock that's performing very poorly, losing money, all of that, to go up 400%, and you still aren't up. You still are just even, break even. Trust me when I tell you there are a lot of other stocks that are going to be able to make your money back than you trying to sit in this stock and wait it out and ride it out and wait for it to come back. You don't have to make your money back in the same stock that you lost your money in, And so The way that the way that it works is very interesting, right? I mean, an 80% drawdown means you got to go up 400% just to get back to even. And the funny thing about these candles, we probably ought to go. Like somebody, this right here is a price. This is a trade that took place. Like someone, or maybe several someones, literally paid $307 for this stock back in February of 2021. And it is now worth $29. You know, like there's no guarantee that person is still in the stock, but I bet you some of them are. I bet you some of them are. And that's what we call holding the bag. You don't want to be a bag holder, and that's why we follow stops at our firm and in our personal accounts.
Absolutely. So awesome. Well, Shane, good to catch up again, and we'll see what this market does. Still kind of just churning, but I'm betting on a break lower. So sounds like you are too, but let's see next week. We never know if we're going to be right. It's all about probabilities. So
Yeah. A break lower, but not until after probably a short covering bounce of some sort. So we're
yep,
already a little oversold, I think, for the short term. So I think maybe a little bounce, and then we'll make a new lower low.
absolutely. So awesome. Well, you enjoy the rest of your day. Thanks for joining again, and see everyone next week.